In 1929, a 23-year-old borrowed money to bet against the stock market, weeks before the greatest crash in history. He made about 50% while millions were wiped out. His name was Irving Kahn. And he kept doing this, going into the office, picking stocks, until he was 108 years old. Kahn wasn't lucky. He was disciplined. He learned one idea early, from the greatest teacher investing ever produced, and he never let go of it. And that one idea is the reason he was still working when almost everyone his age was long gone. Here's the number that matters. Kahn's very first trade, a short sale of magma copper in the summer of 1929, returned roughly 50%, just as the market collapsed around him. How did a kid barely out of school see it coming? He didn't, really. He wasn't predicting a crash. He just started working as an assistant to a man named Benjamin Graham, the professor who basically invented value investing. Graham taught at Columbia, and Kahn became his teaching assistant. He sat next to the master for years. And a young Warren Buffett studied under that same man. Kahn absorbed one lesson above all others. A stock isn't a ticker. It's a piece of a business. And a business has a value that has nothing to do with today's price. But here's where it gets interesting. Most of Graham's students used his ideas to get rich fast. Kahn used them to make sure he never got poor. Ask most investors what they want, and they'll say big returns. Kahn wanted something different. He was obsessed with not losing money. He put it simply. He cared more about the return of his capital than the return on it. Get your money back first. Profits come second. Think about what that actually means. If you lose 50%, you need 100% gain just to break even. That's the trap that destroys people. One catastrophic loss can erase a decade of good decisions. Kahn built his whole method around avoiding that one loss. So how did he do it? He bought companies that were already beaten down, so cheap the market had given up on them. In his words, he liked stocks so battered they couldn't fall much further. That's the margin of safety. Buy $1 of value for 50 cents, and even if you're wrong, you don't get hurt badly. Now, quick reminder, this is educational, not financial advice. Always do your own research. So let me ask you. When you buy a stock, what do you check first, how much you could make or how much you could lose? Tell me in the comments. Here's what nobody tells you about Irving Kahn. The secret wasn't a formula. It was time. He co-founded his firm, Kahn Brothers, in 1978 when he was already 72. Most people are winding down at 72. Kahn was just building his own shop. And the firm managed around $1 billion, decade after decade, on the same patient principles. This is the counterintuitive part. Compounding doesn't reward the smartest investor. It rewards the one who stays in the game the longest. Kahn played for 80+ years. He didn't try to win every trade. He tried to keep playing. And there's a beautiful detail here. Kahn read constantly, company reports, newspapers, books right into his hundreds. He said he never worked a day, because he loved it too much to call it work. His mind stayed sharp because he kept using it. The investing kept him young, not the other way around. But here's the question that really matters: could you hold a single idea for 80 years? Most investing advice ages badly. Kahn's didn't, because it was never about the market. It was about temperament. He lived through the crash of '29. Black Monday in '87, when the market dropped 22% in a single day. The dot-com bust. The 2008 crisis. Every one of those, the crowd panicked. And every time, the patient investor who bought value and refused to sell in fear came out ahead. Kahn didn't chase the hot thing. He didn't trade on headlines. He bought unloved businesses at cheap prices and let the years do the work. That's the whole thing. Simple. Almost boring. And nearly impossible to actually do, because it requires patience most of us don't have. Remember what I said at the start: a 23-year-old betting against the market in 1929. He wasn't a gambler. He was the opposite. He spent his entire life making sure he'd never be forced out of the game. That's the lesson. You don't get rich by being brilliant once. You get rich by being disciplined for a very long time. Irving Kahn proved something rare. The market doesn't reward the fastest hands. It rewards the steadiest ones. Survive first. Compound second. Everything else is noise. So here's my question: could you really hold one strategy for 50 years without flinching? Yes or no? Tell me in the comments. Tomorrow, we're breaking down the one balance sheet number that quietly warns you a business is dying long before the stock price does.